Dividend decisions. I request you to see this immediately after time value of money chapter, so that you will get more logical understanding of the dividend decisions calculation and all, right? Now, the earnings per share may be 10, market price of the share being 100, market price being 100, earnings per share being 10. Now, so if you purchase a share for rupees 100, you will be getting earnings per share of rupees 10 every year, we assume. The company will have the dividend policy this way. Every year we need to give the dividend. Okay. Dividend in all the year. Okay. All the year. Some number. And sometimes dividend will be given and sometimes not given. So this will be regular. Sometimes irregular dividend. Okay. If they think they are having sufficient money this year, they want to announce dividend, they will announce sales. There is no any systematic approach. Some cases, the company may decide no dividend policy. We should not give any dividend. Okay. So the constant dividend policy, every year they will pay out of 40, around 6 rupees per annum may be payable. Per annum will be payable. This will be called a constant or regular dividend payable. Irregular, in this year they may announce a dividend, next year they don't announce the dividend, or a couple of years there will be consistent dividend, thereafter no dividend. Some company will follow no dividend policy. No dividend policy. Clear? Some company will follow residual dividend policy. Residual dividend policy. Okay. Now, what is the logic behind all these things, sir? Actually, the logic behind all this model is, if you are able to give constant dividend, investors could be very happy. Like they will be getting a fixed interest, like fixed dividend. They will be happy. So they will have more faith on this company. They want to invest more in this company. To attract the investors to purchase in our company, invest in our company, the company may have the policy to give consistent income. Or the company may get the investment from various investors who are in need of monthly some return or yearly some return. Sir, I already aged. If I invest, will I get consistently some money? Yeah, of course, we'll give consistently 5 rupees or 6 rupees for every 100 rupees. Very happy, sir. That's okay. Those types of investors, if this company has more, then they plan for go for dividend. Irregular dividend. Never mind about the dividend. They just invested. Huge money is there. The company doesn't know what to do with that. Then they can announce the dividend. Else they can sell it. The investor never mind about the penny amount, the dividend. So in those cases, no irregular dividend will also be there. Some case, no dividend. What's the logic behind that no dividend? Some newly startup company requires huge capital. Initially, they could have invested 1,000 crore. Next year, they made 300 crores profit, but requires additional investment 400 or 500 crores. Every year, it requires more investments to expand as it's a growing one. So whatever the earnings they get now is plowed back in the same business itself. So reinvested. They don't have the fund for distributing the dividend. That case, they will follow no dividend. But as investor, if I invest in this company, there is no dividend. What is the benefit for me? Very simple. Because of the reinvestment, there will be consistent growth in their value. I never bother about the today's income, but I bother about the means capital growth in sometimes later. If I invest 100 rupees, it should come around 500 rupees or 600 rupees in a matter of 2 or 3 years. That's what about my intention. Don't give me year on year interest. And residual income. Okay. Once again. Okay. In case of residual dividend, they made a profit of say 10 lakhs. For the expansion in this year, they are in need of 6 lakhs. So the residual dividend income, what they have is nothing but only 4 lakhs. They earned 10 lakhs in total. 6 lakhs is used for reinvestment. 4 lakhs is the ultimate amount left unused. This may be given as a dividend. This is called residual dividend model. So the dividend policy decided by the management is as per their investors' requirement or board directors' intention and all. And the logic behind the payment of dividend also plays the vital role in price determination. Right. Now let's see. We'll move on to the next one. Stable dividend also we have. Stable dividend. Clear. You understand? More or less same, but slight difference is there. Dividend every year I will pay, which is called regular dividend. Either it may be 1 rupee or 10 rupees or 3 rupees, doesn't matter. I will constantly pay is called dividend every year, regular payment. What is called stable dividend? In stable dividend, we have 3 models. One is constant dividend. Constant dividend. So the EPS in the very first year is 10, second year is 15, third year is 12. Earnings per share year on year may be totally changing. Okay, total earnings for the company divided by the number of shares is the earnings per share. Under constant dividend model, the dividend payable for the every year may be 3. If the company decides 3, that 3 remains constantly payable over the 3 years. It's called constant dividend model. Or they may follow constant payout model. Constant payout model. Constant payout assumed to be 40%. What does it mean? Out of the earnings note, to the extent of 40% will be released as dividend year after year. As per this logic, for the 10 rupees, the first year dividend being 4 rupees, second year dividend being again 40% and 15, 6 rupees, then 40% and 12, it is 4.8. Clear? This is the logic. And later one being, they will offer stable dividend, stable or constant dividend plus some extra. What does it mean? They will constantly pay, say, around 4 rupees plus 60% will be payable like if the EPS is more than 11%. That's how they will decide. In the very first instant, it's only 10 rupees. Then naturally the dividend payable being 4 rupees. In the second scenario, it's 15 rupees. So 4 plus 60% of EPS in excess of 11%. So 4.6. Another case, 4 rupees plus 0.6 of value in excess of 11%, 1 rupee and 0.6. Okay, this one I think 3 to 6.2 or 6.4. In this case, it is only 4.6. Clear? So this is also stable dividend based on a constant number payable every period. Out of the earnings, certain percentage will be payable is the second model. There will be a stable dividend plus some extra will be payable. So these are the cases you have to understand. Clear? Hope now you'll be able to understand this. Now, let's start with the C. Questions are in order number 1, 2, 3 like it is given, but I may solve in a different angle. You can also study along with that angle. 1, 2, 3, 4, 5, 6, 7. Like we have so many models. I'll jump here and there, but I'll cover all the dividend policies. Shall I start with the first one? Seventh one. Directly I'll go for the seventh one. Okay. The way how I'm teaching, the order I'm teaching, no, that order will be applicable once you complete the time value of money. If you are strong with the time value of money, you come here with that same stream. You will understand this very easily. So as I already told you, you have to be master with the time value of money. If you are master with the time value of money, almost you have completed 50% effort. Already you have completed 50% effort. Find out the intrinsic value of share today. If the share paying dividend 10 rupees every year, redeemable at its face value, that is 100 by the end of 4th year. Assume cost of overall capital being 12%. Now we have to find out what is the value of the share. Okay. Clear? See, no need to worry about that. This is the first illustration. I am starting with the first illustration. Company offers various dividend to the shareholders. They have lots of pattern like regular dividend, irregular dividend, constant dividend, right? That's the second part. So I'm going from question number 1 onwards, but I don't follow the same order. Okay, you just master yourself time value of money and then follow the order I'm teaching you so that we have the grip over this time value of money as well as dividend also. Clear? So the first sum I'm going to solve here is 7th one. Okay. Find the intrinsic value of the share today if the share paying dividend rupees 10 every year and redeemable at its face value 100 by the end of 4th year. What does it mean? 0, 1, 2, 3, 4. If you purchase this company's share, you will be getting dividend rupees 10 every year end. By the end of 4th year, you sell the share and you will get around 100 rupees. Now, how much will you be able to pay for this particular share currently, where your cost being 10%? 12%. Clear? Come on, can you guess the answer? It's very simple. Discounting of these values. Discounting of this value. That's all. So, for the 10 rupees, you have to multiply with the PV factor at the rate of 12% for 4 years. Plus, for this 100, this is annuity factor. Annuity factor. Which annuity factor? Present value annuity factor. Present value annuity factor. If there is a stream, then it is annuity. Are you going to calculate the tomorrow's value for the annuity or today's value? Today's value means it's present value annuity factor. And for this 100, we have only one value. Then you have to use what? Present value factor at the rate of 12% for the 4th year. Yes. Come on, get me this value first of all. And then 100 into this value. In your non-scientific calculator, I told you how to calculate the annuity factor and PV factor. Okay, in case of PV factor, 1 divided by 1.1. This is PV factor for the first year plus PV factors for the second year plus PV factor for the third year plus PV factor for the 4th year, 0.6355. Here 0.6355. There is a PV factor. Annuity factor is nothing but summation of all these PV factors. So you take the grand total button in your non-scientific calculator, but I don't have the grand total button here, so I am taking the MR button here. This value being 3.037. 3. Okay. Now final value being 30.37 plus 63.55. Now what is the final value? 93.92. So for this company shares, you are able to pay 93.92. Don't study this for exam purpose. Study for your real money purpose. So if so many people are very interested to know how can we calculate the stock's price, very simple. This is one of the method. You just estimate what could be the revenue you can get because of this company's investment. If it is being a newly invested started company, a new startup company, we are not sure. We cannot guess. But a strong company having almost 10 to 15 years of experience, you can predict what could be the revenue we can expect from this company. If you are able to predict around 4 or 5 years value, based on that, you can use the discount factor to find out the share price value. Very simple. So to master yourself to understand how to value the shares, you can make the money rather than mark. But this is the fundamentals. A couple of weeks ago, I addressed the students of Bishop College. So I just communicated to them. I applied only the basic financial accounts principal rules for my stock analysis. I made a nice profit. But when I suggest this to some of my friends and relatives, they always scared to invest. Okay, they will go for some public opinion and investor and lost the money. Okay, but understand the fundamentals never go wrong. The fundamentals will have the impact in the price maybe quite a bit later, but definitely the price will be adjusted to its own true value sometimes later. That's why you can call this being intrinsic value. Intrinsic value is a true value. Now compare the true value with the market value. If the market value is 50, what will be your opinion? Go investing. If the market value is 120, slightly higher, okay, you can give some other factors also. If it is being 500, then investing in this company is foolish, right? So this is a diamond you found. This is okay, you are moving with their market. This will be a foolish investment. Foolish investment. Now what happens, some people in investments, if you plan to go for stock market investment, your friend will say, I made 100% gain. 100% gain. The next moment, he will ask what? What share, sir? Curiosity will be there, right? Yes or no? What share, sir? Immediately you tell some X company share. Okay. Then immediately he purchases. This fellow purchases. And for him, this becomes 150%. He says 50% profit, sir. You told this one. He tells that I made a profit of 50%. Not only that, he tells to see, super profit, I made 50% profit. Not only myself, my predecessor A had almost 100% revenue. This fellow, so without intimating to me, he again purchases. And he makes a nice profit of 20%. And all the three becoming promoter for that, brand ambassador for the company, then automatically D comes, he purchases without stating anything. Next moment, he loses 50%. He now scores all the three. Now the problem is, this fellow invested at 50 rupees. He made 100 rupees profit. Then it is 100. 100 is almost right price. This fellow made a 50% profit. Again you add, then it becomes 150. Reasonably okay. Now it's slightly overpriced. This fellow purchases and from there another 20% gain. So 20% means 30, 180. This fellow enters at this price. So I told you it's the right price at this moment, cheapest price at this price, and this will be the right price. But this is a foolish price. So what happens, if you run very fast, usually I tell, if you run very fast in a running race, they ask you to stop immediately in a point. Will it be possible to stop? Definitely not so. We don't have the brake system. In bike also, we drive very fast. Suddenly some obstacle comes. Can you stop? No. Even though you apply all the braking system, it will travel at least for 50 meters or 100 meters. The same happens. This fellow is very cautious. 50. At 100 he stopped because he starts applying the brake from here itself. Though it applied, the price is now moving upward without brake. That goes on. These are not real worth. These are nothing but there is no possibility to apply the brake. Sometimes later, after crossing certain limit, the price will be shooted up like anything. Why? No braking system to stop. Okay. All started talking about the company. Because of this exorbitant talking about this company, new people having no knowledge will be the prey in that. They enter and lose the money. So that's the problem. As a financial management analysis, you need to understand what is the worth you are able to pay. The worth you are able to pay for that can be calculated based on this chart. And also the tactics of payment of dividend, how this plays in the price determination of the share in the market. Right. So where we are going to apply the Gordon's growth model, Walton model, Modiglin and Miller. These are the three famous models we have. Okay, Gordon and Walter, these two are talking. If you are paying the dividend, the company's image may be differently valued. Okay, depending upon some situation. If you pay the dividend, the company's value may be different. If you don't pay the dividend, the company's value may be different. Modiglin Miller says, no sir, whether you pay the dividend or don't pay the dividend, the price remains the same. So we are going to argue, we are going to verify these two arguments. What are the two arguments? Gordon's growth argument, Modiglin Miller argument. Otherwise, Gordon growth and Walter models are same. Slightly different view will be there for Modiglin Miller, right? But for all these things, you have to apply what? Simply time left. Let's see the next illustration. Come on. Find out intrinsic value of share today if the share paying dividend 10 per year and share is irredeemable. Assume KO being 12%. What happens here? 0, 1, 2, 3. Irredeemable. Every year it pays you how much? 10 rupees for how many years? Infinite period. What is your KO? Your KO being 12%. Now, what could be the price you are paying for this particular company's share? What's the formula for this? What model is this, first of all? Perpetuity annuity. Annuity with perpetuity. We don't have an N number. We have seen that now the formula derived where P is equal to or this dividend. Dividend is equal to P into K. Okay. And in case, what's that? Rather than P, if I want to calculate P, the value being D by K. We have studied this way. S is equal to P by I. P is equal to S and I. That's how we studied. So the same is applied here. So the formula being this one. So P is equal to 10 divided by K being 0.12. What's the value? Come on. So you will be willing to pay 83.3 rupees for this share. Clear? Now, let's move on to the next one. Clear? Online students, come on, text me. Yeah. Ninth one. Find out intrinsic value of share today. If the share paying dividend 10, 15, 12, 17 for these 4 years, redeemable at its face value 100 by the end of 4th year. Your cost of capital being 10%, now you have to find out the shares price. Year 1, 2, 3, 4. What about your cash inflow? Cash inflow is nothing but dividend or redeemable price. Year 1 you get dividend rupees 10. Year 2 15. Year 3 12. Year 4, 17. So year on year, the dividend what you receive is totally different. Totally different. Is that clear? Now, apart from that, in the nth year, you will be getting 100 rupees also refunded, redeemable price. So, if the dividend being constant, you can use the anti-factor. If it is not constant, you have to use PE factor for each and every period. So, PE factor at the rate of 10%. Come on, what is the PE factor for the first year at the rate of 10%? 0.909, 0.826 for the second year, 0.751, 0.683. This is common for both. So the last two are be in the last year itself. Now find out the discounted cash inflow. The discounted cash inflow being 9.09. Okay, then 12.39, 9.01, 11.61, 68.30, 110.4. 110.4. Is that clear? Is there any values mismatching? Correct or not? Yeah. Clear? Shall I move on to the next one? So, this topic seems to be time value of money, right? That's all. Okay. We'll move on to the next one. That's why very often I tell the students to master the time value of money, even spend time for understanding the derivations also. The reason why I ask you to memorize or understand the derivation is that the time stream, timeline, how the cash inflow is happening and which formula can be used, that you can easily guess. You can easily guess. So I request you to try to solve all the illustration from CA Foundation as well as CMA Foundation, especially this chapter, time value of money. That will be helpful for constructing the base fundamental financial management, right? Come on. Question number 10. Find out the intrinsic value of the share today if the share paid dividend rupees 10 today and showing a growth rate of 5% for infinite period, assuming KO being 10%. What happened? You got 10 rupees today, but never bother about that. Today you don't get. If you are purchasing the share, today's dividend you don't get. You get the dividend only by the end of first year. By the end of first year, you will be getting 5% excess than this 10 rupee. Means 10 rupees into 1 plus 0.5. Next year, you will get 10 into 1 plus 0.5 to the power 2. So each and every year, you are getting 5% excess. D0, I can name this being D0, where the dividend is announced and offered for the shareholders today. If you invest, then of course you don't get this dividend today. You will be getting the dividend only by the end of first year. By the first year end, you will get the growth rate for this at the rate of 5%. So your dividend by the end of first year being 10.5. This is D1. This D1 is nothing but D0 into 1 plus G. And the next year, again you are getting another 5% on this, which is how much? 5.525. Isn't it? 10.5 into 5%. Come on, tell me. 11.025. You will be getting, this will be the D2, dividend 2. This is nothing but D0 into 1 plus G to the power 2. Next year again you add, and this goes on for how many period? Infinite period. Now you have to discount all these things to find out the shares price. So the last one being 10 into 1 plus G to the power infinity. And now what is the price of the share today, where the rate of interest is equal to 10%. Now, what's the formula for this? Huh? Have you studied this one also? Growing annuity. We have seen the annuity with perpetuity, growing annuity. Okay. Oh, I have deleted. Huh? Okay. Go and check the growing annuity. Okay, I deleted. Okay, no issues. Then what's the formula here? P0 is equal to D0 into 1 plus G divided by K minus G. This is the formula. Okay, there I may use S is equal to whatever the notation is different. Notation is different. The constant payment, that dividend, the cash inflow at the 0th period is the starting one. I may use a P1 or D1, whatever the term we use. S is equal to P1, like I think I have given in a regular formula. That same formula is used here. Hope so you will be able to now understand. Go and see the time value of money, second lecture, derivations of various formulae. Now 10 into 1 plus 0.05, 0.05, okay, 5%, divided by K being 0.1 and G being 0.05. Yes, find out the value. I think 210. So you are now willing to pay 210, or this company share price could be 210. Seems to be intrinsic, maybe fair value, maybe fair value. Clear? We get this one now. Online students, come and text me. Now let's move on to the next one. I got the message from only one of you, Archana. What about the others? Text me. Yeah. So I'm watching you all. So if you keep responding me, then I'll keep your name in my mind, as you are being the online students. Usually I'm not able to remember your face and all. Okay. So somebody will say, once I visited the CMA conference in Bangalore, 2 students directly came and interacted with me. Sir, how about you? And when did you come to all? So I just surprised, saw for some while. Where did I meet? Sir, you have not met me, sir. You taught me over Google only. Then, so at least I need to know the name. Keep texting your comments here now and then, right? Now let's move on to the 11th one. Find out the intrinsic value of the share today. If the share paid dividend 10 today and showing abnormal growth of 12% for first 4 years, and then the growth rate becomes normal, GN, stabilized at 5% for infinite period, assuming the KO be 10%. Right, what happens here? 0, 1, 2, 3, 4, 5. This 10 rupees is nothing but dividend at 0th period. For the first 4 years, we have an abnormal growth of 12%. First year end, the dividend could be 10 into 1.12. 12% will be addable. Second year, another 12% will be addable, otherwise 10 into 1.12 to the power 2. Third year, 10 into 1.12 to the power 3. Fourth year, you will get 10 into 1.12 to the power 4. Fifth year, how much will you get? From fifth year onwards, the growth rate is normalized, stabilized at only 5%. Up to 4 years, you get this much, 10 into 1.12 to the power 4. In the fifth year, from that you are getting only 5% growth. You are going to add only 5%. So into 1.05. Into 1.05. Hope you will be now able to understand the logic. So very first year being D0, 10. We never bother about this because we are not going to get it. So the moment dividend announced, I supposed to go and purchase. So definitely this will be for the seller, not for myself. It's not for buyer. So I'm going to get the dividend by the end of first year. So I had to wait for 1 year. So add the growth here for the first year, which is 12%, so 1.2. So the next year I will be getting 11.2, which is nothing but D1. Again I am getting abnormal growth of 12% with this. 12% of this is how much? 1.344. Then my dividend by the end of second year being 12.544. Again, abnormal growth for the third year I am getting at the rate of 12% on this. Come on. How much? Okay, 53. Okay, 1.5053. Now, what is the dividend I am getting by the end of third year? 14.049. Okay, then again abnormal growth is there at the rate of 12%. 12% on this being 1.69. That's all. Three digits. 685. See, if we follow 3-digit method, you have to tell me always 3-digit method. 685, right? Now, come on. So the D4 in this case be 15.735. I can round up this much. And thereafter in the fifth year, growth becomes normal. Up to the first 4 years, we have the abnormal growth rate at the rate of 12%. Thereafter, it's stabilized at the rate of 5%. Now you have to find out that growth at the rate of 5% and this. Come on. 0.786. That's how it goes so on. Infinite period. So infinite period. So finally, it is 10 into 1.12 to the power 4 into 1.05 to the power infinity minus 4. But infinity minus 4 has no any significance, so infinity only. Clear? Then how can we calculate the value of this company share? Okay. Now see. This is called two-stage growth model. Can we apply the formula, sir? Yeah, of course, I taught you the derivation. You can derive the formula for this also. But rather than deriving the formula for this, you can simply follow a straight method calculation, right? So both the methods are acceptable. Either you can follow a newly constructed or coined derived formula, or you can simulate slightly existing formula and you can use that formula to get the p value. See here. Now you know that P0 is equal to, this is all about constant growth annuity. Okay, growing annuity. What is the formula for growing annuity? P0 is equal to D1 divided by KE minus G. Am I right? This is what about the constant growth. So since when you are getting the constant growth, you are getting the constant growth of 5% from this date onwards. So if you are getting the constant growth in the first year onwards, this will be the formula. But the constant growth now you will get from fifth year. Automatically, rather than D1, you have to take D5 here in numerator. Divided by KE minus G is the answer. And as we get the PO, if the D is being the first year end value, as in this case, D is the value we get by the end of fifth year, definitely P4 will be the value possibly we are able to get. It's not P0, P4. So from this, it is very clear, this entire stream of cash flow can be found out using this formula. Found out using this formula. Is that clear? Growing annuity. A constant growing annuity starts from fifth year. If it starts from the first year, naturally P0 plus is equal to D1 divided by KE minus G. Rather than that constant dividend starts from the fifth year. Then 1 year ahead. P4 is equal to D5 divided by KE minus G. Right? What about the remaining four, sir? For the remaining four, you can use simply present value factor. You can use simply present value factor. Is that clear? So now see. Year 1, 2, 3, 4 and cash inflow. Cash inflow being first year you will be getting 11.2, second year you will be getting 12.544, third year you are getting 14.049, fourth year you are getting 15.735. Apart from that, thereafter a stream is there. No, what about this value, sir? You have to find out and put that also here. For that D5 being, come on, you add up this. This will be the D5. 16.523. Slight 1 paise, 2 paise difference, you just keep that. 16.523 divided by KE being 0.10%, 0.1 minus G, the normal growth this period being 5. It's not abnormal growth, it's all about normal growth divided by G normal, 0.05. What is the value? 330.46. Okay. This will be as per fourth year value, 330.46. You are getting from working note here. Now you have to discount all these 4 values or 5 values to the present value using the cost of capital here. PV factor can be used. PV factor at the rate of 10%. First year PV factor being 0.909, second year being 0.826, third year being 0.751 and 0.683. 0.683 is the common for these two. Now multiply this, discounted cash inflow you will be getting. The discounted cash inflow in this case being 10.18, 10.36, 10.55, 10.75 and 225.70. You add up all these things. This is what about the shares price you're supposed to pay today. 267.54. Clear? Now, we'll move on to the next illustration. Before we move on to the next illustration, I may solve this illustration the other way. The other way. Right. See, here 0, 1, 2, 3, 4, 5 goes on up to infinite period. Here the value being 10 into 1.12, growth rate being 12%. Next year 10 into 1.12 to the power 2. Here 10 into 1.12 to the power 3. 10 into 1.12 to the power 4. 10 into 1.12 to the power 4, but hereafter the growth rate is only 5%. Infinite period 10 into 1.12 to the power 4. For the 5th year, we start with 1. So definitely 1.05 to the power infinity minus 4. But anything subtracted from the infinity is infinity only. Infinity is the biggest possible number. From there, subtracting 4 seems to be insignificant value. It remains infinity. That's the logic. As already told you, this is two-stage growth model. A first stage has abnormal growth. Thereafter, it has standard stable growth. For the stable growth, we use the earlier formula. Okay, growing annuity formula. But if we have two stage, we can use growing formula for the stable and earlier period, the abnormal growth period. We can use a single payment present value factor. Okay. Instead of that, we can apply this formula also. We can apply this formula. Okay. Now, P0 is equal to D1 into 1 minus 1 plus abnormal growth rate to the power n divided by 1 plus cost of capital or rate of return to the power n divided by cost of capital or rate of return minus growth for the abnormal period plus d abnormal growth period plus 1 divided by k minus normal growth rate multiplied with 1 divided by 1 plus k to the power n. Okay, this is another form. This is the another form. You can substitute directly here. No surprise here. The second term, this one, is nothing but growing annuity. What is the formula for growing annuity? P n. N represents the number of years that we face abnormal growth is equal to dn plus 1. Dn plus 1 means here the abnormal growth is for 4 years. No, thereafter 1. So d5 is, this is nothing but d5. This is nothing but p4 divided by k minus normal growth. So if you do this, you will get the price of the share by the end of 4th year. To make it today's value, you have to multiply with the p factor. P factor is nothing but 1 divided by 1 plus I or here k to the power 4. Clear? So this is nothing but this value 330.46. Okay, clear? And this one, you know, that formula seems to be pretty massive. Rather than applying this formula, you can calculate this way. All the four value put together, what the value you get, you know, directly you get here. Directly you get by applying this formula. Now tell me, do you want to memorize this formula or do you want to simply calculate this way? That's why I didn't teach you this one. But in in CMA book, no, sometimes they solve using this method. Sometimes they solve using this method. So by the time you should not get confused. And especially in CMA material, no, this formula with no proper alignment. Everything may be in single line. P0, D1, multiplication 1 minus 1 GA. This is how it. Reading seems to be very tough. But I have made it to present in such a way to understand easily. Any of this formula is not required to memorize. But I have given the formula derivation for this one also. Earlier page it is available in time of you just see. Formula derivation is available for the growing annuity for a specific period. Okay, this formula is all about growing annuity for perpetuity. This is growing annuity for perpetuity. This is growing annuity for a particular period. Hope I have given that formula also in time value of money. But I have not guided you in the class. Is that okay? Clear? Present value, page number 1.2.15. Present value of growing annuity for a particular period. Okay. So only for 4 years or 5 years, how can we use? Formula is given. Or the same formula is given in page number 1.2.13. Okay, it's repeated there also. So here this D1 is nothing but D0 into 1 plus growth abnormal. In page number, I think in 15, last present value of growing annuity, the next page the value is given. Here P0 into 1 plus G, that's how it is given here. Thereafter this is given. Thereafter this is given. Is that okay? So I have given the derivation also. If you want to mug up this, of course you can do so. But of course there is other easy method. So why do you want to panic with this complicated method? Anyhow, the next illustration we try to solve under both the method. We'll go for the question number 12. If it is clear, text me. We'll move on to the next one. In the next illustration, I may solve using this method also. Clear? Shall I move on to the next one? 12th one. In the 12th one, a large sized chemical company has been expected to grow at 14% per year for the next 4 years. GA, growth abnormal, 14%. For how many years? Growth abnormal, number of period for the growth abnormal is equal to 4 years. And then to grow indefinitely at the same rate. Thereafter, same rate as the national economy, that is 5%. Growth normal, thereafter from the end to infinity period, it is at the rate of 5%. The required rate of return of the equity share being 12%, which is nothing but K, 12%. Assume that the company paid a dividend of 2 per share in the last year. So this is nothing but D0. Last year or present, if that statement is given, it's nothing but previous year value, D0. D0 being 2. Determine the intrinsic value. What you can do, you can apply the two formula state. First 4 years, you can calculate the dividend. From the 5th year onwards, you can use the growing annuity, infinite period formula to get the answer. But anyhow, there is one more formula you know, so I am going to solve this illustration using the other formula. See here, P0 is equal to D0 into 1 plus G abnormal. Otherwise, this is nothing but D1. Okay, multiplied with 1 minus 1 plus abnormal growth to the power n for the abnormal growth divided by 1 plus k. 1 plus k to the power abnormal growth period divided by k minus growth abnormal This is for the first 4 years value. Thereafter, from the 5th year onwards, up to infinite period, you get no. For that value, I need to add one more. How can we add? The value is very simple. D5 you have to take. D5. D5 should be taken, otherwise DN, abnormal growth period plus 1. So D4 will be taken. To calculate the D4, DN1. The next year value will be taken. D5 need to be taken, divided by K minus growth normal, but this is nothing but the value for the D5. So D4, sorry. So this is the value for the D4. To make it 0th period, you have to use the present value factor, which is nothing but 1 divided by 1 plus K to the power abnormal growth period, N. Abnormal growth period. So 2 segment, this is nothing but growing annuity, its value. This is all about abnormal growing annuity only for a temporary period, 4 years. Okay, usually this seems to be pretty much to memorize. This is very simple to memorize. Okay, this you can easily calculate. So I usually recommend no need to memorize this. You can use the previous method. You will get the same answer. In Singar Academy text, I have solved this illustration under both the methods. But here, I am going to solve using the formula method. So here we see D0 being 2 into abnormal growth being 1.14. The first abnormal growth being 14% into 1 minus 1 plus abnormal growth rate being 14%. The abnormal growth period being 4 divided by 1 plus K being 12%, 0.12 to the power 4, whole divided by K being 0.12 minus growth abnormal period being 0.14. Apart from that, this one D5. D5 is nothing but 2 into 1.14. Thereafter, 5th year, I get only 5% extra growth, so 1.05 divided by K being 0.12, normal growth rate being 0.05 into 1 divided by 1 plus K being 0.12 to the power N being 4. N being 4. Come on, try to solve this illustration. Final value being 40.62. Try to find out the answer. Come on. So question number 13. Z Limited is foreseeing a growth rate of 12% per annum in the next 2 years. So growth from year 1 to 2 being 12%. The growth rate is likely to fall 10% for the 3rd and 4th year. Growth for the 3rd and 4th year being only 10%. After that, the growth rate is expected to stabilize at 8% per annum. So from 5th year onwards, 8%. For how many years? Infinity period. If the last dividend paid being 1.5, D0 being 1.5, and the investors' required rate of return, K, what the investors are expecting. This may be sometimes named as R, sometimes K. Okay, R represents return on investment expected by the shareholders. K is nothing but cost to be offered to the equity shareholders, company's perspective as well as investors' perspective. Investors say it is a return, company says it's a cost. Right. When it is all about dividend, no, we use only R. When we are studying the same for the cost of capital next lecture. So after this, I will go for the cost of capital. In that, I am going to teach you how can we determine what is the cost of raising the fund by equity shares. Cost of raising the fund by equity share is nothing but return expected by the equity shareholders. The reversal of this chapter is the cost of capital. Again, time value of money is applied there. Clear? So the value here being 16%. Find out the intrinsic value per share. So here, 3-stage growth model. 3-stage growth model. First year, year 2, year 3, year 4. Year 1, dividend being how much? D0 into 1 plus G. Okay. Second year, D0 into 1 plus G, first growth, to the power 2. Third year, D0 into 1 plus G for first year to the power 2. Now you have to multiply with the growth for the second year. Okay. Sir, very confusing, sir. Forget about this. Cash inflow. D0 being 1.50. Growth very first year being 12%. Come on. What's the value? 18. 0.18. 1.68. This is D1. Add growth for the second year. Growth for the first year 12%. Growth for the second year also 12%. Come on, tell me 12% and this 0.20. Then the value being 1.88. This is nothing but dividend for the second year. Add the growth 3. Growth 3 being only 10%. 0.188. Then what's the value? 2.068. This is D3. Thereafter G4. G4 is also 10%. 0.207. I stop with the 3 digits. Then I'll get the D4. D4 being 2.275. Huh? Then D5. How will I get the D5? So, fifth year being only 8%. So, I am going to add growth for the next year being G5. Only 8%. How much is that? 0.182. Then total value being 2.457. 2.457. Is that clear? 2.457. Okay. 1, 2, 3, 4. What about the cash flow? First year I am getting 1.68. Second year I am getting 1.88. Third year I am getting 2.068. Fourth year I am getting 2.275. Thereafter I get consistently. If I am getting consistently, then you have to follow what? P4 is equal to D5 divided by K minus growth applicable from that period. D5 being 2.457 divided by K being 0.16 minus growth applicable from that period being 0.08. Yes, come on, tell me this value. 30.71. 30.71. Seven one or 7.8? 7.1. So I have shown this as 7.8 in Singer Academy text. I go with that. Probably rounding of error will be there. Now you have to find out the P factor at the rate of 16%, which is given here. 16% P factor. They have given. 0th period not required for me. To confuse you, it is given. So you have to start with the first year to fourth year only. 0.86, 0.74, 0.64, 0.55. The same is applicable for the last also. Now you have to multiply these two to find out the discounted cash inflow. The discounted cash inflow being, if you are multiplying these two, so 1.45, 1.39, 1.33, 1.25, 1.25, last one being 16.9. The total being 22.33. Hope you will be now able to understand the price. Clear? Find out the intrinsic value of share today. If the share paid dividend 10 today, means D0 is equal to 10. Showing an abnormal growth rate of 12% for the first 4 years. Growth rate, very first 4 years being 12%. And then growth rate is stabilized at 5% for infinite period. The abnormal growth rate is for how many years? 4 years. Thereafter, normal growth rate is there, which is 5% from 5th year onwards, infinite period. Assume KO being 10%. KO or return. Sometimes it may be return expected. Okay. R or K. Apply H model. So we have to follow H model. Okay, for share valuation. So now we are going to follow the H model. See, the question is pretty different. If the share paid dividend 10 today and showing abnormal growth rate 12% for the first 4 years, and then growth rate stabilized at 5% infinite period. Okay, follow H model means the growth appears this way: 0, year 1, year 2, year 3, year 4, year 5, year 6, goes on up to infinity period. Up to infinity period. Clear? The growth in the very first year being 12%. 4, 8, 12. The first year growth be 12%. And up to 4th year. Thereafter, it is stabilized at 5%. Until the previous case, this remains 12%. Thereafter, it becomes only 5%. But H model states that the growth is linearly decreasing this way. Thereafter, you will have the constant growth rate of 5%. This will be 5%. This will be 12%. Probably here it may be 10%, like so. 12 becomes 5, gradually decreased period after period. Okay, clear. So it is not 12% in the very first year. Very first year 12%, second year I am not sure. Third year also I am not sure. But fourth year it becomes 5, means gradually decreasing. Probably 12%, 5%. First year, fifth year. Second, third, fourth. 7 rupees, 7% difference is there. Maybe 14, sorry, this may be 10. This may be 9. This may be 7. This may be 5. That's how the growth is showing. This is a logic. Also linear. It's not exact. So what about here, sir? 1.5 years. It may be some average value of this. For this, of course, you can memorize a formula here. That formula includes H. See, here I am going to give the formula. You better memorize that formula. Price at the 0th period is equal to dividend 0th period plus growth normal divided by K minus growth normal. Okay, with that add D0 and H, growth abnormal minus growth normal, whole divided by K minus growth normal. Clear? Or you can simply add up these two. Clear? That way also you can show. Now, what about this H's are half of that abnormal growth period. Half of the abnormal growth period. Now substitute the values here for this illustration. D0 being 10 multiplied with 1 plus normal growth, which is 5%, 0.05, whole divided by, you can club these two and make it single formula also, no problem here, right? Plus D0 being 10 multiplied with half of the growth period, the abnormal growth period being 4, so 4 by 2 into abnormal growth being 0.12, normal growth being 0.05, whole divided by K being investors expectation, which is 0.1, minus normal growth being 0.05. This is what about the price of the share at the 0th period. Clear? So here it's better to memorize this formula. Of course, there's again formula derivation, not required. Not required. Because this question is pretty rare. Smooth declining model. Smooth declining. It is not 12, 12, 12, 12 for the first 4 years, thereafter suddenly decreased to 5. That model is not here. Earlier it is 12, by the end of 5th year it becomes 5. Gradually the growth is decreasing. Maybe from 12 it may be 10, 9, 7, like it's decreasing year after year. Clear? As we are not aware about that model, so we use H model here. This particular formula seems to be how? Similar to what? Growing annuity. Similar to the growing annuity. And you have to include this component additionally and H additionally. That's all. So you can very easily memorize this. How can you memorize? Growing annuity formula. So I think the final answer being 238. Okay. How can I memorize this, sir? Very simple. Growing annuity. Growing annuity formula being D0 into 1 plus growth, which is normal growth, divided by K minus normal growth. Because of the abnormal growth, I am doing one more addition, which is nothing but the same formula, D0 H growth abnormal minus growth normal divided by K. In order to simplify this, because I have shown this into two formula like to make you understand, the first set is nothing but similar to what? Your existing growing annuity. Second set, similar to that same, we have the denominator, only numerator, GA minus GN to the H extent of DO will be taken. That's all. H represents the half of the abnormal growth period. Half of the abnormal growth period. Now, we'll move on to the next one. We'll move on to the next one. Clear? Online students, come on, respond me. So I got the message from Udeshri. What about the others? Make it faster. Now, two more illustrations. With that, we'll finish today's lecture. I can complete this topic in the next class itself. No issues. Question number 6. We'll directly jump to question number 6. Residual model. What does it mean? Whatever the earnings is there, to the extent of expansion, you reuse it. After reusing, whatever the amount left over can be given as a dividend. XYZ Limited is a large fast food chain following a residual dividend policy. The total capital budget for the next year is likely to be one of the three amounts. Capital employed by the first year in next year, maybe 20 lakhs or 30 lakhs or 40 lakhs. The forecasted level of potential retained earnings next year retained earnings being 20 lakhs retained earnings, otherwise earnings they earn maybe 20 lakhs. The target or optimum capital structure is debt to ratio 40%. Whatever the capital employed, in that they can source using the debt, source it using the equity. I need around 1 lakh rupees. How can I arrange that 1 lakh rupees? Out of my own cash or can I borrow? Sir, usually we'll borrow 40%, sir. Balance we can source our own fund. So as the next year we are in need of so much, 20 lakhs. How much out of that could be sourced by debt? 40%. So out of 20 lakhs, 40%, 8 lakhs could be borrowed, 12 lakhs we arranged by our equity. So overall 20 lakhs is now arranged. So from this it is very clear. Next year, as I am in need of 20 lakhs for the expansion purpose, for the 12 lakhs is from the equity. From the equity means the equity shareholders fund. The retained earnings also equity shareholders funds. Now I am using this one. Okay. Invested for the new. Reinvested. How much is reinvested? 12 lakhs is reinvested. Whatever the leftover balance that will be dividend. That will be given to the shareholders. Sir, we made 20 lakhs profit. Out of that, 12 lakhs is used for the expansion and we finally end up with 8 lakhs, no more required for us. You can have this as a dividend. This is called dividend under residual model. Suppose in the next year, if I am having 30 lakhs as my requirement for the capital expansion, retained earnings being 20 lakhs. Out of 30 lakhs, as per our company's policy, 40% can be sourced by debt. Balance 60% could be sourced by equity. So debt being 40%, equity being 60%. My retained earnings is 20 lakhs. From that, reinvestment is done for 18 lakhs. Balance 2 lakhs can be distributed as dividend. If next year, if my requirement being 40 lakhs capital requirement, out of which from debt we can source 40%, 16 lakhs. Balance 24 lakhs I have to source from equity. So here retained earnings is only 20 lakhs. We are in need of this one. So almost 24 lakhs. Already we are running short of cash. Another 4 lakhs we are in trouble. So we can issue further equity shares to rise it. So definitely we don't have any money for distributing the dividend. So this is called residual model. This is called residual model. Clear? Right.